When the union budget of this year was presented, right before that, the government spoke of the economy being in a Goldilocks period. Low inflation, high growth. Talk about things going wrong, because 4 weeks after that, the war started, a war which at this moment we seem to have no idea about whether it is ending, has ended, will end, will never end, when will it end, we don't quite know. And therefore, in this massive economic turbulence, navigating the economic ship is amongst the toughest thing one can have to do. What's the diagnosis at this moment? How much of the typhoon has the economy dealt with? How much lies out in the future? And what's the time frame? Do things get worse in days, weeks, months, or do they not get bad at all? To talk about this, I'm joined by the man who's in the unenviable position of having to predict multiple unknowns all at the same time. Can we have a round of applause for Dr. Ananta Nageshwaran? Thank you very much, sir.
Thank you, Rahul.
And welcome to NDTV Ignite.
Thank you.
It's great to have you with us. When people look at the economic situation at this moment, they wonder, is this the worst? Is the worst behind us? Is the worst ahead of us? How far ahead of us is the worst when it comes to the growth trajectory of the Indian economy? So let's kick off from there.
Thank you, Rahul. I think in your initial context-setting remarks, you had a very multi-layered statement to make. Why February 1st? In fact, I would even say February 27th evening, together with the Secretary, Ministry of Statistics, we were releasing the new GDP series, and I was saying, look, I'm upgrading my GDP growth projection for FY27 from 6.8 to 7.2 range. I was upgrading it to between 7 and 7.4. It might sound like a trivial change, but I was removing the 6 angle completely. But then next morning, everything changed. So look, we still have large unknowns, especially the El Nino effect on the monsoon, etc. But having said that, I would say now in the last 1 week or so, I'm beginning to breathe a little easier. I can see a glimpse of the possibility of India kind of having seen the worst in terms of potential impact of the ongoing conflict. So I wouldn't have felt this way in April or May, but now I'm beginning to think that with the measures put in place on Friday, the 5th of June, and considering how the oil price has behaved so far and how the fertilizer prices are moving right now, I have a feeling that we may be able to handle FY27 much better than what we may have feared in April or May.
You know, when we spoke after your economic survey,
right,
I said you were being overly conservative. I now think you're being overly optimistic. Are you trying to talk up spirits? Because you're saying that the worst is behind us. I'm not sure. Try and explain why. And you're saying that we will do well. When so much is going wrong, why do you think we'll do well?
No, I think you are right to push me back, Rahul, but I was making a relative statement. I think if I said, I didn't say I am confident of saying, I'm confident of our economy doing better than what I thought on February 27. That's not what I said. I said compared to what I may have feared in April and May, I'm beginning to breathe a little easier. So I was kind of hedging myself still, and you still want to push me back. But I think I still concede the big unknown.
No, you'll have to explain this, because you're saying that you're feeling better now than you were in April.
So I'll give you
Try and explain that, because a lot of the economic writing that's coming out of different think tanks, different banks, economists, they're saying that the actual impact of the turbulence of the past 100 days will be felt in the quarters ahead of us. So what makes you think that the worst is behind us?
First of all, there are multiple answers to your point. First, we are going to have a GDP estimate of 7.7 for last year, FY26. And RBI has come up with 6.6, which is a 1.1 percentage point lower than last year, with a downside risk attached to it. I still stand by that. I think that's a fair characterization. And then RBI says 5.1% inflation with an upside risk attached to it. That's also correct. So we are going to see the impact in terms of higher inflation and lower growth compared to last year. It's about the magnitude of the impact. There I am beginning to breathe a little easier, and that reason is, I think oil price has behaved far better than anybody might have anticipated, given this blockade and given the conflict, because A, there is excess supply coming from the strategic petroleum reserve of the US and other countries, and China's demand has been extremely low. China has been buying far less oil than they used to. And then look at the second, besides oil, the second biggest impact on us would have been the fertilizer price. And urea prices today are lower than what they were even before the conflict began. That would have been a huge hole in our fiscal budget, in the cost of cultivation. A lot of things would have had a sort of a chain effect, chain reaction based on that. That is also now seems to be very much under control. And the third reason is, on Friday, the 5th of June, we took some actions on the balance of payments side through bond market withholding tax, capital gains tax exemptions on sovereign bonds, and RBI's FCNRB scheme. And fourthly, I took a very close look at the way our oil import behaved in 22-23 when the Russia-Ukraine war started. That year, our oil import quantity went up by 8 to 9%, and the price also went up, was remaining above 100 for 5 to 6 months, and yet the current account deficit went to only about 2.2% of GDP. Now, if the fertilizer price had not come back all the way below the pre-conflict level, I wouldn't be sounding this much more relaxed than I am. But it is precisely the behavior of the oil price until now, and the urea price decline, and the action we took on June 5th, I think all these things are making me breathe a little easier compared to April.
Whether this is true or not, we will know in some time.
Of course.
But the fact that the economic advisor, who's I've seen clearly very conservative in terms of his forecasting, thinking that the worst is behind us, is a significant point that you're making. Explain what you imagine to be the role of China in stabilizing oil prices and helping urea prices actually come down.
Sure.
Is this happening because China is trying to play the role of the emergent superpower, or does it reflect deep underlying distress in the Chinese economy, because of which they simply don't have enough urea consumption of their own, which is why they're exporting?
No, I think whether they are playing the emergent superpower or not is beyond my pay grade to speculate on. But definitely, I think the domestic economic stagnation that continues in their economy is playing probably a big role in the reduction in their crude oil import. I mean, of course, they did play a stabilizing role in the 97-98 Asian crisis. And then in 2008 global financial crisis as well, they did play a stabilizing role. So it could very well be possible that they are playing a conscious stabilizing role, which I can't rule out. But that said, I would probably attach greater weight to the possibility that their continued domestic economic stagnation is playing a very big part in bringing their oil price down and also opening up the urea market for export. But be that as it may, regardless of what the underlying cost is, both are helping the Indian economy and our own external situation quite considerably at this point.
We've seen about a 7.5 rupee pass-through on petrol and diesel prices from the oil marketing companies to Indian consumers. Dr. Nageshwaran, according to you, how much more of a pass-through is required or likely in the days and weeks ahead?
So how much more is required, of course, will depend on the evolution of the oil price going forward. But even now we can say that by raising them by 7.5 rupees, we have covered up to the last year's average price for India was $68.7 per barrel. So these increases have taken us up to, let's say, a price of $85 per barrel. So even now, with the likely evolution of the oil price this year, which is as of now, taking April and May actuals that India actually paid, which is in triple digits, but assuming that the oil prices behave the way the financial markets are discounting now, the full year price may be close to about 88, 89, and we are not too far away from what we have passed through. So what we may need to pass through further may not be that big, provided oil prices conform to what the financial markets are currently discounting.
What impact, according to you, has this war had from what you can see? We see the data that's in the public, you're seeing things from more closely on private consumption and potentially on corporate taxation, given that there is a very real concern about companies pulling back on account of contracting demand?
Sure. First reaction is, I think it is still early days, given that we only have 1 month of fiscal data for current financial year to talk about the corporate tax revenue or personal consumption, personal taxation, etc. But having said that, it is encouraging again, one more reason for my relative calmness, so to speak. We have had 2 months of data, March and April, after the conflict began. High frequency indicators have shown that the domestic demand is holding up very well. And that could naturally mean better revenues for the corporates. And you know very well that the fourth quarter of the last financial year, profitability also turned up for the Indian corporates. And then the other good news is that the nominal GDP growth, which we assumed in the budget to be around only 10.1%, is more likely to be 12% this year rather than 10.1, which is 2 percentage points higher. And that also means better revenue compensation than what we may have assumed. So even if the buoyancy were to go down a little because of economic uncertainty, the higher base, the nominal GDP growth, will compensate for a lower buoyancy. So that is why I think we may not have to be unduly pessimistic on the revenue front.
Some of the economic forecasts that are coming on the downside are now beginning to talk about whether we could slip potentially even to a 5 point something, 5.9 or whatever. You're still holding out at 6.6. How certain, or with what degree of certainty do you feel that we're likely to be in the upper part of the 6 bracket and not inching towards the lower part of the 6?
Look, below 6 is possible if the conflict continues and if the production shut-in of the oil market continues, and then let's say China's lower import stops at some point, and the United States decides that its strategic petroleum reserve has come down to a level where they have to refill it, etc. And if the oil price starts ruling to the north of 100 in the second half of the Indian financial year, then an outcome of GDP below 6% is possible. But right now, if you ask me, I would say a characterization by the central bank of 6.6 with a downside risk attached to it, which could be somewhere between 20 to 30 basis points on the downside, I think that is more realistic to me as things stand.
What impact so far has this war had on the desire of Indian companies to invest? Because you, not just you, the finance minister, the prime minister, everyone in government has been trying to talk up India Inc., asking them, exhorting them to go out and invest more in the Indian economy. Again, given the capacity utilization numbers that we saw, there were some signs that this was beginning to pick up in a realistic way, which could have given us a 5-year virtuous cycle. Given that this war is now upon us and the uncertainty that it creates, are you again fearful that the groundwork that you've done, a brake has been slammed on it?
Again, sorry, we can't speculate because we don't have the data. That's one of the important data gaps in this country faces, where we don't get quarterly frequency on how the capital formation in the private sector is happening in the country. But that said, look, if you look at the overall capital formation rate, it's about 32% of GDP in the economy, which compared to many other countries in Asia, it's actually on the high side, given the level of uncertainties in the world. And secondly, the CII keeps sharing bottom-up data on corporate investment, and they say that the listed companies in general are actually beginning to invest a lot more than what they used to do until about FY24 or so. So they are saying that from the second half of FY25, continuing into FY26, listed companies have ramped up their investments. So obviously this war definitely would have made them pause a little bit, but there are compensating factors for us, which is the trade agreement with the UK, trade agreement with the European Union, and the renewed interest in European Union in terms of diversifying from dependence on China, etc. I think there are other compensating factors that are coming into play, which might offset the uncertainty caused by the war. Therefore, it is difficult for me to speculate beyond this on what the magnitudes will be because we don't have the data. But there are compensating factors.
No, you're speaking of compensating factors. Let me counter argue that these free trade agreements potentially create the prospects of further imports coming into India from these advanced economies with which we're now either signed up or signing free trade agreements without our manufacturing being competitive enough at this moment. So it could actually work in converse as well, because one of the experts who came to ignite in the morning. The argument that he was making was that a free trade agreement at a time of relative calm and of growth is one thing. Given that these agreements are being signed at this moment, when there is uncertainty, all the products from countries like New Zealand, Canada, elsewhere, United States, once that deal concludes, could start coming into the Indian markets, creating further trouble for Indian corporates.
No. If there are going to be imports coming from a region with whom we have signed a free trade agreement, obviously those imports are coming in from there in lieu of where else they might have come from. And that would mean that we are getting them at a lower price, only then our businesses would substitute for them. That still means lower landed cost. So even if those imports pick up from those regions, I am sure it is because in lieu of some other source. And therefore, I wouldn't consider that as a negative, I would consider as a positive. If you are importing equipment from country A, and now country B is your free trade agreement partner, and the duties have dropped to zero, and therefore it has become more competitive, then please tell me that my input costs have gone up. Unfortunately, no.
No, what about products coming in for the use of consumers, which potentially may have been buying from Indian companies, then buying from companies from where now you have an FTA?
Most of our imports are mainly infrastructure and intermediate goods. So you have to get into the weeds of the imports to be able to make such definitive statements. And secondly, both UK and the EU agreement are giving us a lot of opportunity in terms of labor-intensive manufacturing and services opening up those markets which were closed earlier. And to that extent, those businesses, especially the medium enterprises ones, now have an incentive to ramp up their investment to be able to meet the norms set by those countries. So I think on balance, our imported goods will become less costlier if we are sourcing it from a free FTA agreement country, and the market opening that we have got for labor-intensive goods and services will be incrementally positive. I think it is somewhat, in my opinion, somewhat a stretch of an argument to say that this could be actually negative.
You know, you spoke of data which we don't get. Let's speak for a moment for data that we do get. And I want to take unemployment numbers. The headline numbers from the PLFS says that, the periodic labor force says that headline unemployment is 3.2%. When people look at that and just anecdotally and they look around, India having an unemployment headline number of 3.2 just intuitively and instinctively feels to be an underassessment.
So that I think people have to separate both involuntary and voluntary unemployment, because what the unemployment rate measures, there is a usual status, there is a weekly status. So it depends on the kind of questions people ask. And second, if you are been looking for work, and if you are willing to take up whatever work that is offered to you, and yet you are not employed, then you are counting as unemployed. So it depends on the way the people are choosing to remain unemployed. If there is a lot of involuntary unemployment, then you may see that a lot of people are unemployed, but you don't know whether they are voluntary or involuntary. Okay, involuntary ones will count. But if you are voluntarily unemployed, it won't count. So you may on the streets, if you encounter some 20 people who could have been employed but are not, you have to find out which one is voluntary, which one is involuntary. That is why your anecdotal evidence and what statistical evidence presents you may appear somewhat disconnected. And secondly, I think we are not doing as good a job as we can yet, and it is a question of data improvement. We are not measuring the gig economy work as well as we do. I think a lot of people are taking, not being part of a formal workforce, but still having 2 or 3 jobs because they feel the flexibility suits them. I think we are not doing as good a job of measuring them, etc. And at the end of the day, it is still true that notwithstanding all these question marks in people's heads about employment, household incomes have been growing much better than what people have been expecting, given this kind of anecdotal perception on employment. So I think on balance, given the kind of uncertainties that is there in the world, I think the employment picture as revealed by the PLFS is an accurate one.
One of the government's big promises has been that India will become a Viksit Bharat by 2047. Now this fundamentally requires growth to be above 8% for 2 decades and more for us to be able to achieve it. Now we've seen for 2 years growth being less than 8%, and this year somewhere around 6.6%, maybe lower. Does this war just make that much tougher the already very difficult task of India becoming a developed country by 2047? And does it exacerbate the risk of India getting caught in a middle income trap?
Look, obviously every year where the growth rate doesn't meet a particular level that you think is required. First of all, I don't think it's necessarily true that you need to grow at 8% in real terms in Indian rupees over the next 25 years for you to get to the Viksit Bharat status.
What are your calculations?
So in fact, a growth rate of between 6.5% and 7% in real terms in Indian rupee, and that too it cannot continue until 2047, because by definition, as the base becomes larger and larger, the growth rate will taper off. So up to 2035, if you are able to grow on average between 6.5 and 7, and after that if it tapers, ultimately in dollar terms, you also have to take into account the inflation rate that will prevail in the United States. That is what, so basically the way you calculate your dollar GDP is, growth rate in dollar GDP is Indian real growth rate plus the United States inflation rate will give you the Indian GDP in dollar terms. Now, many developed countries are suffering from high public debt, and therefore there is a possibility of inflation tolerance in those countries in the coming years in order to bring down the debt. That is how they brought down their debt, among other things, after the end of World War II. So, given all of that, even if your growth rate after being at 6.5 to 7 for a decade and then tapers off to below 6 and then tapers off further in 2040s to around 5.5%, if the US inflation rate is averaging between 3 and 4%, then your ability to achieve the figure of between 25 and $30 trillion of GDP is possible. And philosophically, I will also add that at the end of the day, we have to keep doing whatever is in our control in order to get that goal. But exogenous factors can always either aid you or hamper you. That's not in your control.
Do you feel sometimes unlucky? Because there are two things
Sure.
this government did. One is when corporate taxes were reduced,
COVID
soon after COVID happened. Now you rationalize GST in a big way. Again, the government implementing the policy maneuver that it could, and soon after the war happens, just when you expect a takeoff.
That's a very good question, Rahul. I think in general, we should not rule out the role of luck in outcomes. And I think it's usually human nature is to attribute it to oneself if it succeeds and attribute it to bad luck if it doesn't. So I think, but beyond a point, that's also exogenous. You have to take it as it comes. But we have to keep plugging away. And I'm sure one day the luck also will turn. For example, from 2014-15 onwards, when the government came to office, initially there were deficient monsoons, but then we also enjoyed a very sharp decline in the energy price, in the global crude oil price. So as the government was dealing with the aftermath of the banking NPA crisis and deficient monsoons and trying to fix the fiscal deficit, which was high when they inherited it, the decline in energy prices helped. So that is a good fortune. So similarly, I'm sure
while we've had a run of good monsoons for a few years, we now potentially face a super El Nino.
Right.
How worried are you? Does that keep you awake at night? And explain to those watching at this moment the impact you think a super El Nino could have on agricultural production and on the larger economy.
No, I mean, when I said I was relatively slightly breathing easier compared to April, May, but still there are two big unknowns. I said one is the energy price going forward, and second is the effect of El Nino becoming a super El Nino. I think the Kharif crop should do well, especially the cereals, pulses and oil seeds. I don't know enough. They may have an impact. But more than the Kharif crop, the real impact could be in the next Rabi crop, because the super El Nino will probably be felt towards the latter half of the calendar year. It may not be felt during the current monsoon season, but yes, to the extent...
How is the government preparing for that scenario?
I think the government is obviously assessing the reservoir levels, the stock levels of fertilizers, and how much is sowing happening, and whether there is enough. So, like in the previous such situations, it is the management of inventory, management of export and import, ensuring adequate quantities and domestic inflation not rising, etc., apart from ensuring water resources. And luckily for us, the reservoir levels
are we prepared, Dr. Nageshwaran, to deal with the super El Nino, according to you?
I don't have the information to say whether we are prepared or not, but I can say reservoir levels are 23% higher than what they were last year. And the sowing by the farmers who are aware of the projections by the IMD, both in April and May, the sowings have been much healthier than last year. So the farmers seem to be assessing that given the stock of fertilizers and given the stock of, given the reservoir levels, they feel that they can handle the impact of the super El Nino on the Kharif crop output. That much confidence we can say.
Let's spend a moment on the dollar. and where things stand versus the rupee. We've dealt with the politics of it. Different people have come and they've spoken, oh, how weak a government this is, the dollar could be headed to 100 rupees. From an economic lens, how much of Forex should the RBI burn to try and protect the level of the dollar versus the rupee, just so that politically it doesn't fall under 100 rupees?
I think the central bank Central bank may have expended reserves in moderating the volatility of the currency in the past 2 years, but with the action taken on Friday, both with respect to the bonds and with respect to the inflow of dollars, I don't think the RBI will be required to burn dollars to defend or manage the currency volatility going forward.
Foreign investment in India is at a 14-year low, foreign portfolio investment in India. You've made some changes to long-term capital gains on sovereign bonds. What's your view on doing the same to the stock markets? Because on equities, so many of the investors we speak to in Hong Kong, New York, elsewhere, say they just don't find India attractive enough.
Look, I mean, India's markets gave 4x appreciation between 2020 and 24. I think part of these conversations are because of the last 1.5 years, the market not going anywhere. So therefore, in order to boost their after-tax return, now either if the returns are not there, then they want the government to tinker with the tax framework. On the sovereign bonds, compared to many other nations of comparable nature and competing with us for capital, on the bond side, we were a bit of an outlier. But I don't think we are an outlier with respect to equities.
So you are not advocating for a change in taxation on securities or a change in taxation on long-term capital gains for foreign investors?
So that is not for me to say, but at a personal level, I don't...
आप जो बोलते हो बाद में होता है. You know, you, for example, at a time when speaking in favor of investment from China wasn't fashionable in policy circles, you advocated it. So it doesn't, you can't just get away by saying मेरे बोलने से कुछ नहीं होता. That's not necessarily true.
No, I was going to tell you my answer. I said I'm not the one to decide.
Yes.
But personally, I feel the case for any change in the capital gains taxation framework for equities is that much weaker compared to the case was there for the bonds.
Then why, according to you, are foreign portfolio investors not look? Because
that's what I'm
even
saying.
after
The case is
recent
weaker.
correction of more than 10,000 rupees from the December highs, price earning multiples are still 21. So from their lens, when they look at different portfolios to invest in, India still looks expensive.
See, I think if you look at it philosophically, you know, between taxing capital and taxing labor, when there is so much happening with respect to AI, and even if there are productivity gains from AI, and those are more likely to accrue to owners of capital, etc., the continued clamor for somehow providing tax relief to capital, and when the balance between capital and labor is still not balanced, I think we have to be a little bit more critical and questioning of the demand for more tax relief for capital owners.
Interesting. One of the reasons the government was able to spend on public infrastructure in the way that it did over the past decade was because crude oil prices were low. You were able to use the taxation that you had to create a corpus to go out and spend on CapEx. Now that you've had to cut excise duties, how likely is the government to go out and fulfill its commitment on capital expenditure in this budget? Or do you think by the end of the year we'll find that the government, in an attempt to try and meet its fiscal obligations to the extent it could, start cutting back on public spending?
Again, as I said earlier, I think we still have only 1 month of data and 11 more months of data to come. And I think it is difficult for us to speculate on the various ways in which the government will be able to meet its capital expenditure target and yet keep the fiscal deficit from slipping away from the target. I'm sure there are ways, and we have faced similar situations in the past. So I don't think we should judge right now that capital expenditure will be a casualty of the current situation.
No, but it depends on how you define priorities. What is more important, going out and spending on capacity expansion? Is that more important, or trying to show that you're still being fiscally conservative given the circumstances? That's more important.
It is a balancing act. All you can say is the balancing act has become that much more challenging. That much I would concede. But beyond that, it is premature or not necessarily appropriate to speculate on the kind of balancing act that we will be required to perform.
What's your outlook on inflation from here on? We're seeming to head towards the upper hinge of the threshold which is deemed acceptable, and things could potentially get a lot worse.
I told you at the beginning, RBI's projection of 5.1 with an upside risk attached to it seems to be a fair assessment at this point. And mind you, we were in 25-26 averaging less than 2%. So it is already factoring in a huge sharp increase when they project 5.1. And they also say that the risk is more towards the upside rather than downside to this number. I think that's a fair characterization.
No, but the impact this can have is potentially create societal distress. You've got a situation where salaries are not rising because of artificial intelligence. Many people are being laid off. You've spoken against that companies need to be careful, but companies, frankly, in a bid to protect their bottom line, are doing what they need to. And therefore, as an economist, how concerned are you about this cocktail of multiple factors operating at the same time, creating conditions ripe for societal distress?
So salaries, I understand that based on the quarterly earnings reports, I understand that salaries in general have grown at double digits in 25-26. So that is not the real issue. The real issue, what you mentioned about AI, is about entry-level jobs. That's a different discussion, and that is something which we need to address regardless of the West Asia conflict or not.
No, but how can it be addressed? Given that technology is moving in the way that it is,
correct.
What can government and people in policy-making positions do to even try and address it? Because companies will do what they need to for their own survival.
Absolutely. I think the important thing is, yes, governments and the industry, both of them have an obligation to play, and as well as the youngsters themselves. All three of them have to figure out how do you basically create jobs in the AI-dominated world, is to create more AI-insulated skills and AI-insulated jobs, and that is where the free trade agreements with labor-intensive services and manufacturing come into play. If you look at the budget, we created a huge incentive for the care economy to take off, whether it is allied health professionals, tourism sector, and caregivers and culinary skills. All these areas are the ones where AI will not make an impact, at least for the next few years. And therefore, it is important for us, both union government level and states and the industry, to continue to make the AI insulated skill areas a priority. And that is the way. Of course, a problem of a technological change is not handled in 1 quarter or 2 quarters. We have to make the effort.
There's a lot of argument around whether India has missed the AI bus. Where do you come out on this argument?
So suppose you look at whether India missed the internet bus. You could have asked the question in 2000, where India didn't have a Cisco or a Intel or any of those broadband cable companies or any of them. But now today, considering the way we have harnessed internet for digital public infrastructure, for payment system, etc., you wouldn't say that India missed the internet bus. So I think the precedence is quite encouraging for us. We may not be in the hyperscaler. In fact, I would even say there is a second mover advantage, given that we are not frittering away huge capital resources on trying to emulate the hyperscalers.
I have many more questions, but I know you have a hard stop.
Yeah.
So we'll pause here. Asking those questions was the easy part. Trying to answer them in the economic volatility that the world faces is the far tougher part. For taking out time and joining us, thank you very much. It's interesting to see how you've pivoted from being conservative and telling people to be, just not get carried away in February, to now trying to talk up spirits as we reach June. It'll be interesting to see whether it's the conservative avatar or the optimistic avatar of Ananta Nageshwaran that comes out on top at the end of the fiscal year.
No, at the end of the day, I am data-driven. So the data are giving me some hope and glimmer of encouragement, and I shared it with you.
Thank you so much for taking out time and joining us, Professor.